Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly discussion of current market conditions, answer very important questions in terms of support and resistance for the next 10 days as earnings season unfolds, and what to expect going into summer, right? Up, down, sideways, which sectors outperform, where does it make sense to park the money, and risk management, right? Risk management is important, so we're going to talk about this since we are trading in a trader's market. This is not an investor's market, this is a trader's market. So that's what we want to discuss today. For those of you who are new, welcome. This is my brief bio. I was Executive Vice President and Head of Technology at Options Express from its inception through 2007. Options Express was an online broker-dealer. My background is technology. I work as a CTO in several financial startups here in Chicago. Some of them went public. Started Tradespoon over 10 years ago. Always since companies went public, I did realize that nobody is going to manage my money better than I do, and I think most of the people on this broadcast will agree. You know, that's why we're all here. So that's what I've been doing. But my background is technology, building technology, managing money. So I want to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally. Managing and trading my own money. I've been doing it for over 15 years. Mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures are very important. Please read them. If you're new to trading stock and options, I encourage you to visit optionsscreening.com link to understand the risk associated with trading stock and options. I'm not a financial advisor, not registered with FINRA nor SEC. I'm showing you what I do in my own account, based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. All right, before we jump into trading plan, let's talk about current market conditions. And we need to answer a few questions, right? So first of all, let's look at the macroeconomic data. Today, it actually came in better than expected, right? Better than expected. Flash services PMI was higher than expected, and manufacturing data was higher than expected, actually above 50. Right, we dropped to 49, and now manufacturing data jumped above 50, which means expansion, and that was a positive surprise. And as soon as the data came in, yield had a pretty big rally, right? Because they started pull back with the expectation that it's going to be worse than expected, and as soon as the data came out, we have a strong rally in yield, which is a very important kind of distinction between March and prior to March, right? Prior to March, if you look at the way market worked, is that when yield went up, that was bad, right? That means that inflation is strong and Fed is going to raise interest rates. Ever since probably the March 13th, right, when the Silicon Valley Bank and we had financial distress, some of the banks went under, the correlation has changed, right? When yield is up, right, that's considered to be bullish, right? And you can see big reversal in spiders. We were down, well, not big, I think we were down maybe, what, 0.5%, right? So we were lower. You know, we did pull back sharply yesterday after worse than expected economic data, leading indicators. We had a big pullback, you know, yield drop, and now yield went up and the market went up. So the idea now, the new correlation is the theme has changed, right? Most people now not concerned with inflation because clearly data is showing deflation, right? Clearly we're seeing deflation across all metrics, even in services data and in shelter prices, right? So we are in deflation, maybe not to the target levels, but incrementally we're going in the right direction in terms of deflation. And now the theme has changed. Everybody now is concerned about recession, right? Because if the inflation is dropping continuously, then why is, you know, 3 months is at 5%, right? 3 months yields 5%. A 10-year yields 3.5%, right? And why does the market goes up, right? Why is spiders up when the 10-year yield is up, right? So fear of recession, right? Today we have better than expected manufacturing and services PMI data, so yield is going up. right? And the market drops because the expectation is that Fed is not going to pivot. Fed is not going to pivot, and interest rates will remain high. When yield drops, expectation that, well, economy is decelerating and potentially entering recession, so Fed will pivot. So that's the narrative, and it's very important to kind of keep an eye on these correlations. So as we're approaching the next 10 days, if you look at the stock forecast toolbox using our neural networks, it's basically market neutral, right? It doesn't know about the Fed meeting on May 2nd. It doesn't know about the earnings season. You know, we're done with the first week of earnings season. It just looks at the tape, right? It looks at the price action. It basically says if the market reaches 412, it's probably overbought, and maybe it makes sense to sell, right, for the next 10 days for today. And then 408, probably a good buy for Friday. And if you zoom out for the next 10 days, potentially we can reach February high, right? 418, 419, 420. Next week, I think we're going to have, I think, all the big guys announcing next week, right? Apple, Microsoft, all the mega cap technology. Let's see. 2 weeks, right? Is Microsoft next week? I think Microsoft is a little bit earlier. Yeah, okay. So you have Microsoft, you know, we had Tesla, Microsoft gonna start announcing, you know, visas of the world. So next week is kind of next 2 weeks will be the peak of the earnings season. So then the question becomes, you know, where are we heading in the next 10 days? Model basically sees if Microsoft delivers strong earnings, right? Potentially we can get to the year-to-date high, right? Which is this level, 415. Let me make sure you guys can see it. Yeah. So that's your February high, right? About 415, 416. And model says, well, based on earnings, and even though it doesn't know about earnings, based on the earnings, we can get to the 416, 420 level. If you zoom out and say, well, great, based on the current price action and the learning algorithm, right? This is a machine learning, and it makes projections for the next 10 days. For the next 6 months, it's projecting that on the upside, you can actually get, if the earnings are better than expected in the next couple of weeks, we can actually get to the August high, which would be 430. And the worst case scenario, if the earnings are not good, then we will retest December lows. Right, so if you go out beyond, you know, April, like May, June, potentially we can get to 430 and better than expected earnings. That would be August high, or pull back to the 380 level. Granted, you know, without having a strong opinion on the market, if you just kind of basically a technician, you can say, listen, looks like distance between current price and December low is 30 points, right? Or the risk is 30 points to the downside. And the best case for 30 is, you know, 20 points to the upside. So risk versus reward, even if you don't have an opinion on the market, or you're just purely a technician, you don't really care, you know, whether we will or will not enter a recession, you just look at the price action, right? Then the risk versus reward, it doesn't make sense to chase the market. If we do get to 420 especially, or 425, it makes sense to sell into the rallies. So that's the question, right? So going into summer, right? April is almost behind us, 1 more week. Then May starts, right? April was the best months, usually the best months of the year from seasonality. Not a lot of, you know, not the best performance. It's kind of flat for this month. And you can see we're going through the top building process, right? We're going through the top build process. We had similar price action in December, right? Sorry, October. We had similar price action here, right? We've seen these kind of top building processes that, you know, sometimes last few weeks, right? And then they pull back, right? And then there's a pullback. Sometimes if the earnings are better than expected, right, then you have rallies, right? So then the question becomes, do we rally to the 430 level or do we drop to 380 level? Which level is correct based on what the model is predicting? Model basically says neutral trend, maybe slightly positive, but the best case scenario 430, worst case scenario 380. So as an investor, as a trader, going into summer, you have to pick the side, right? You can say, well, Vlad, we don't know. It's probably just going to be neutral, right? We're just going to trade at this 410 level. I guess that's a possible scenario 3, right? Kind of a sideways market. Scenario 1, we're heading higher toward 430. Scenario 2, we're heading toward lower December lows, right? So kind of very well-defined range, right? You don't even have to be have a PhD in technical analysis. You kind of can say, listen, we've been trading in this range for a very long time, right? One can actually say for years. If I zoom out to 2 years ago, you'll see we are at the same level that 2 years ago. If I look at April of last year, we were at this level. And if I look at April of 2021, we are at the same level, right? I mean, we were much higher, we were much lower, but now we're in the middle. So for the past 2 years, market didn't go anywhere. And that's the argument for that we are in traders market, right? Because if you start investing 2 years ago, you don't know how to short the market, right? You're just always buying, right? Then best case scenario in the 2 years, you're flat, right? Worst case scenario, you're probably down if you started investing 2 years ago. So how do you wear traders hat? And the traders don't care about bull bear market. They care about price action, right? They see this as a sell signal, right? They see every time we hear it's a sell signal, right? And every time we hear it's a buy signal, right? This is how traders think, right? They look for these bottom building process, top building process, and price action. So let's put on our trader's hat and going into summer. Do you believe one, we're heading higher because Microsoft, Apple, Visa, Nvidia will deliver strong earnings, better than expected earnings, and the bar is set low, right? Very low, very easy to beat now. Versus 2, right? Bar is not set low enough, right? You have cases like JP Morgan, right, hitting a home run, or Abbott hitting a home run, and then you have cases like AT&T, right, or Regional Financial today, right, where more or less, or Tesla, right, worse than expected. So let's do that. 1, 2, or 3. 1, we think you're bull when you think we're heading higher because unemployment is low and the bulls have a strong case. 2, we're heading lower toward December support, December, March lows. And 3, you basically either don't know or you just think, listen, nobody knows, you're just going to trade in the range, right? You turn on Bloomberg, CNBC, and half of the contributors basically says you can't really time the market. You should, bottom-up approach, right? You just pick the stock that has strong fundamentals, high cash flow, high dividend, and and then it doesn't matter if we're heading higher or lower. Okay, so 1, 2, or 3. Teresa, thank you. 3, sideways. Thank you. Virus. Logisolve. Video@gmail.com. I have a lot of people that just email kids@yahoo.com. A lot of Carter, welcome Carter. Rob Heller, TJ, Teresa T, Ron, Peter, Patrick, Kevin, Joe, Don, Chandu, Ave, yahoo.com. Sorry, a lot of people just, there's no name. So, okay, 1, 2, or 3 anymore? Only Teresa has an opinion on the market? There's got to be more people. I'll give you some more time. Anybody want to? Even if you don't know, just guess, I guess. All right, we got some 2, down. Okay, so we have a couple downs, couple sideways. Anybody thinks we're heading higher? No ones. Usually there's at least a couple ones. Not a single person said 1. Even 2. Okay. Didn't get any ones. Okay, so it looks like, right, price is exhausted, right? It's been since beginning of April. We're not going anywhere. We're not breaking to the upside. We're not breaking to the downside. Look, judging by February, judging by December, if we're not going higher, well, then we're going lower, right? That's kind of the thought process. Because the good news market, is still down, right? Even though we had better than manufacturing and services data, why is market not rally? It feeds well into a soft landing narrative, but the market is still down. So what are the important data to look at? So the bull case, one of the bullish argument was, look at the semiconductors, right? It almost recovered, not almost, 62%. It recovered 62% of its losses. Strong rally, 50% rally. From 170, we went to 260. And semiconductors are leading indicator, right? If semiconductor is considered to be operating system of our economy, you can't really do anything without, having a chip. Doesn't matter what it is. So you need chips, right? Semiconductors everywhere. And same kind of idea, right? It's kind of a classical retracement in the bear market where it retraces 50%, 62%. And now it's breaking down, right? You can see it's kind of leading to the downside. And it's probably, well, it's broke through April lows, right? So it made new lows in April. And now sitting at this key support, which was kind of the beginning of the March high, right, before the breakout, and sitting on very support. So very weak performance in semiconductors, despite LRCX having a decent earnings, right? LRCX almost trying to break out to 52-week high. We have ASML delivered better than expected earnings, right? So it kind of rebounded almost at 52-week high, and even TSM, which had pretty dismal, forward-looking guidance, but on earnings, at least initial reaction, it was significantly high. You can see kind of a reversal in TSM, and now sitting in support. So what is going on, right? So that is what technicians are looking for, right? One is semiconductors, considered to be a leading indicator toward price action. It is pulling back. It is sitting on a very key, important support level, right? Even here, August high, right? It briefly broke through the August high, which a lot of technicians look for, right? QQQ did not break through August high, right? QQQ, well, right. So QQQ did not. This is the last, rally in the bear market was the strong performance in August, right? From from the, I guess, June lows, right? So, and QQQ did not reach that level, but semiconductors did, right? And it's a very strong argument, and now they're pulling back. So that one level I would watch, and that's why I'm still bearish on the market, because semiconductors are rolling over despite, I think, better than expected earnings. And then the other one is small caps, right? With all the regional banks issues, right? You're not supposed to say this is a crisis, right? You're supposed to say now it's tremors or noise. So whatever you want to call what happened in March in Silicon Valley Bank and other banks, you can see that small cap stocks, whether it's a financial, biotech, small cap technology stocks, they're struggling with the rebound, right? They're not at the August high, very far from August high. Like QQQ close to August high, semiconductors are close because the yield has dropped. But the yield has dropped because of the fear of the recession. And because of the fear of recession, then the regional banks and small cap stocks are underperforming, right? And you can see small cap stocks are also rolling over. So if the semiconductors are rolling over and small cap stocks rolling over, and banks, despite great results from JP Morgan and Bank of America, also looks like pretty weak rebound, very far from August high, right? Not very far, 50%, right? So still underperforming. So that's the argument that people are waiting for Microsoft and Apple results. I assume they're not going to be better than they were in January. If anything, I think they're going to be worse, right? Because Amazon already came out and say, listen, the margins are contracting in the cloud-based computing, right? So cloud-based Azure business, AWS, they're slowing down, and that was kind of forward-looking indicator on the health of the economy and businesses, right? Because if you need cloud computing to run almost any businesses now. So if people are not buying cloud computing, if they're not resubscribing, not renewing, right, then that's an issue. And you kind of can also see this in the price action of AT&T, right? Kind of just sharp pullback with the idea that anything that has to do with subscriptions, it's kind of winding down, slowing down significantly, right? And same thing with price action in Netflix, kind of all slowly rolling over. So that's one of the arguments to be bearish. Also yield, right? Yields precipitously dropped. We do have a rebound today, so this is bullish, but I think it's just a matter of time. Next print, when we have worse than expected data, right? It's a kind of mixed bag. We had the leading indicators. Why is this not being updated? Right, leading indicators are disaster, right? It's kind of accelerating, which is a lot of people are watching leading indicators. Are down, right? Existing home sales slowing down. The Philadelphia Fed manufacturing survey, right? Big drop, deflation. Also, all considered that economy is slowing down, right? Today we had a little bit better than expected. So we have kind of mixed picture, but still I think it's just a matter of time. Yield has continued. It's a pretty weak chart, right? It's sitting on this key support 3.28. It's just a matter of time to break below that level, and if once it does, I think the pullback will accelerate. The bright spot for the bulls is a dollar, right? Dollar is sitting at, I don't want to say, almost at 52-week low, right? So it's sitting at, not almost, it's sitting at 52-week low, right? 50% retracement, that's very bullish, right? Weak dollar is good for, China, it's good for emerging market, it's good for commodity-based, countries, it's good for S&P 500 companies. Weak dollar is good, right? Strong dollar, signs of distress, right? So that's one bullish argument that still kind of makes a lot of sense. But now there are crude oil. A lot of people are mentioning crude oil. It kind of closed the gap after the OPEC announced the cutting of the oil supply. And we closed the gap, right? Precipitous drop. Why? Again, fears of recession. Fears of recession. Okay, so this is nice and wonderful, right? Going to summer, a lot of people, majority of the people, or half of the people, don't care. When they're buying something, they're holding it beyond May and June, right? Who cares what happens in May and June? What happens at the end of the year? What happens next year? Are we heading higher or are we heading lower, right? Is this the low, right? This is the basically million-dollar question, right? December low. Is this the low? Is this the low, right? We were in the bear market. We did sell off more than 20%. We reached 350. Is this the low, right? For the next couple of years, till the end of the year, however you want to phrase it, right? Because that should determine, whether you're a medium-term trader, for you trading, you think a couple months, or longer-term trader, you think, or investor, you think in quarters and years. Because if this is the low, then who cares whether you buy here or here, right? You just buy it in your 401k or IRA account, and as long as it's getting higher, you're happy, right? But if this is not the low, right, even if you're a long-term investor, well, you don't want to overpay 10, 20, 30%, on stocks if you can get them at a discount, right? So this is the, million-dollar question. Is this the low for the year, right? A lot of debates about this. If you're in soft landing, you're going to say, yes, absolutely, this is the low. If you're in the bear market, if you're in the recession camp, then this is not the low, right? Because it's just not, it hasn't been factored into the price action. So type in yes if you think this is the low, right? You say, Vlad, unemployment is low, companies are doing great. Look at JP Morgan earnings, look at who else announced earnings today. Look at Procter & Gamble printing money, look at SAP printing money. Procter & Gamble breaks out into 52-week high, SAP breaking out into 52-week high. Life is good, right? Life is good, and this is the low, right? And then you type in 2 if you say no, it's, it's not. So yes or no? 10%. Thank you, Kevin. Yes, Tesla down, SpaceX rocket. Thank you. Okay, yes, yes. All right, so we have 2 yes. All right, that's good. Anyone else? So sorry. How many of you say yes? This is the low. So if you say yes, we're going to stay above this level, and if you say no, we're not going to stay above this level. Yes, and then no. All right. Yes. Yes. Anybody no? Everybody says yes. Okay. Yes. Yeah. Okay. No no's. I'm going to give a couple minutes. Usually there's at least a couple no's. Nobody thinks we're making new lows? Because I don't like to be, the only person too negative. Okay, it doesn't seem like anybody says no. Okay, I'm gonna say no. This is not the low, right? I'm in the bear camp, right? I'm in the camp that recession is looming, and we're already in recession, right? We're already in earnings recession, right? By definition, when you have 2 quarters of consecutive deceleration in earnings growth, you're in earnings recession. Economic recession, it's kind of a little bit fuzzy definition. It's always in the rare side view mirror. You don't know, you're not gonna know if you had a recession until you're already in recession. But I'm gonna assume we are in a recession or heading into recession, and that means that this is not the low, right? Because this is the low only if we are able to avoid tick up in unemployment, right? And initial claims have been steadily growing, right? And that's another bear argument, that initial claims steadily growing week over week. They are approaching this magic 250,000 numbers. And if you have if you have weeks over weeks close to 250,000 or above, that's usually an indication of recession, right? That that unemployment is going to start ticking up, and and that's confirmation of recession. So I'm in the bear camp. I think we will not hold the lows in the summer. I mean, worst case scenario in October, right? Usually summer is bearish, and September, October usually are the worst months, right? So we're probably going to break the lows either during summer or September, October timeframe. I don't think we're going to break about 430. So if you follow my webinars, if you follow my blog, if you follow my trades, you can see most of my positions bearish, right? Time in the market is very difficult, right? I had the same argument in December, right? If you watched webinar on December 20th, I basically said the same thing, right? Without the regional banks issue. And I thought we will break, at least retest the lows first quarter of this year. I was wrong, right? Few things happen, right? We have China, right? China surprise, right? Zero COVID policy. They went from 100% to 0, right? So that was a pretty big turn. And China economy is reopening and it is growing. right? Better than expected. That's a very strong bullish argument. And so the one thing that happened that, I wasn't, kind of underestimated. The other thing was Europe, energy crisis. Europe was able to avoid energy crisis, right? Warmer temperature, supply from different countries to supplement, shutdown of energy resources from Russia. So we're much higher, right? Something like this can happen again, right? Let's say Russia and Ukraine will reach ceasefire agreement, right? Then the market will rally 430, 440 for sure, right? I mean, I don't know what else could happen. Maybe China accelerates its growth, something along those lines, right? So something like this can happen again, right? But trading is about, again, my favorite saying right now, if somebody asks you, what is trading all about? Trading is not being wrong or right? Because sometimes you're going to be right, sometimes you're going to be wrong, sometimes you're going to have successful or unsuccessful trades. To be a successful trader, you need to make sure that when you're right, you're making more money than when you're wrong, right? That's very simple. If that's your mindset, if you go into the trades with the mindset, I have to make more money when I'm right, and then when I'm wrong, right? Then you can be a successful trader. What does it mean? That will force you to follow certain rules and not break them. Because every time you break a rule, I always think about, well, I have to make more money when I'm right than I'm wrong. And that kind of forces me to follow the rules, right? So whether we're going higher or lower, I could be right or I could be wrong, right? Right now, I think my thesis is stronger than it was in December, right? We have already regional financials, we have debt ceiling, credit default swaps today are at historical high to ensure, United States against the default, right? Because, I mean, most people, 9 out of 10 times, this is not an issue. But, we've seen in the past 20 years that sometimes the US ratings does get, priced down, right? So maybe they can reach an agreement, right? Who knows? But at least you can see it in credit default swaps, right? Kind of a vertical move to the upside. So whether you're right or wrong, the most important, if I'm wrong, you got to make sure that I lose less money than when I'm right. So what does it mean? Well, first of all, bearish, right? I kind of explained. But more importantly, what it means is that you have to have certain rules. You have to believe that trading is the same thing as any other skill you want to acquire. Majority of a lot of you guys are been on my webinar. A lot of you are new. So if I'm kind of talking to someone who's new, is that to be successful in trading, it's a skill, right? It's a job, right? I always try to think about it as you're running your own business. Right? You have to have a trading plan, you have to write things down, you have to keep a journal, you have to have goals, weekly, monthly, quarterly, quarter over quarter, year over year. You have to have meetings, you have to write down an agenda. When you're managing business, trading is the same thing. It's a job, it's a skill, right? And if you think that you can just let somebody else do the job, right? If you can give it to your financial advisor, right? Or if you're gonna just follow Vlad's trades and just magically you're gonna make a lot of money, that doesn't work like that, right? Just like, you can get a coach who's gonna teach you how to box, right? And he could be, Mike Tyson of the world. That doesn't mean you're gonna be Mike Tyson, right? Why? Well, just because it's a skill. It's a skill that requires time, it requires commitment and training. So you have to invest into education, right? What does Tradespoon provide? For the most part, it provides not only signals and making money, but education, because you have to make a determination based on your own risk tolerance level. How many positions should you have and what's the position size, right? If you're managing, hundreds of thousands of dollars, you've been doing it for 20, 30 years, you might have 10 positions, you might have 20 positions, right? If you've been trading for the past couple weeks, right? You probably should not have more than 4 positions, right? And you should not risk more than 2.5% of your account value. So you have to have a very strict rules, especially just irrelevant how long you've been trading in the market. You have to have strict rules that you don't break them. And initially, when you start trading, you break all the rules. That's what I did. And I see that what all the traders do. But as you proceed and going forward, you have to make sure you don't break the rules and you write them down, right? It's a repetitive process. It's a memory. It's, you know, your brain has to have a memory muscle, right? Brain, just like if you want to do push-ups, you can't just watch somebody do push-ups and then magically you're going to do 50 push-ups, right? You have to watch them and how they do it. What's the right way to do it? What's the wrong way to do it? But then you have, every morning you have to wake up and do, you know, today you do 10 push-ups, tomorrow you do, that's what I tell my 7-year-old. If you want to be strong, you know, like that, then you have to, well, you have to eat more. He's a very skinny guy, unlike me. And you have to do more push-ups, right? I always joke around with him. Trading is the same thing. You have to trade every day or every week, right? And if you want to day trade, you have to trade every day, right? If you want to trade, you know, manage your money on a weekly basis, you have to trade on a weekly basis, right? If you want to just rebalance your 401k, well, then you have to do it every quarter, right? You can't skip a quarter. Even if you're just managing your 401k, it requires time, commitment, research, right? So you have to commit to education. Tradespoon gives you live events. Every time I trade, there is a live event. And even if I trade outside of the live event, I would review it at the closing bell or the next morning. So I encourage you to invest into education. That means you have to commit time to either participate live in the webinar or watch the recordings in the webinar. And in terms of rules, if you follow my trading room, where we do live trading room, I always talk about cash, right? If you think that we have reached the bottom, right? If you think we have reached the bottom, I would propose 30% of your portfolio should be in cash. You know, because the idea that we might retest the bottom during summer or October, and you want to have cash to start buying. If you think we have not reached the bottom, I would say your cash should be more. It should be 50% in cash, right? Because we're going to probably reach the bottom and probably break it at some point. So you need more cash to deploy to start buying when stocks like Tesla, you know, is at a steep discount and falls. And the next one is risk management, right? Portfolio drawdown. I propose, you know, especially for the first few months of training, or even first few years of training, depends on where you are on your journey and how disciplined you are. You only have 4 positions on average and 2.5% account value. Because, you know, one of the main arguments for that, if I look at spiders, right, in the past, since April of 21, right, since April of 21, we are trading at the same level, right? We were exactly, you know, 20% above that level, right? And we were 20% below that level, right? So, you know, for the next 2 years, we could be at the same level, right? In the next 2 years, you know, I think we're gonna do this, right? Or I actually think we're gonna go lower, right? We're gonna go higher, and then we're gonna go lower, right? So we could be doing this for, you know, 2, 3, 4 years, right? So if that's the case, right, you gotta, you know, you have to have rules, right? You have to follow them. That is the argument to have only 4 positions, right? Because even this last rally, they were saying out of 500 S&P 500 stocks, only 20 of them, somebody just today on the TV said only 10 of them. So literally, what is it, 10? It's 1%, 2%. So, okay, whether it's 2 or 4%, only 2% of stocks are responsible for the last 20% rally, right? So for to find these 2% out of 100 requires a very good skills in terms of reading, you know, quarterly, you know, sitting at the conference, watching the tone of the CEOs, figuring out their cash flow, and just not piling into a trend, right? Have your own analysis. So very difficult. Majority of the people cannot do this. I cannot do this. And majority of the people cannot do this successfully, right? Long period over time. So for that reason, I propose 4 stocks, because we do have models, right? We have active trader, we have weekly trader. We do have models that will tell you which stocks are outperforming, right? So we will tell you what those stocks, but there is no reason to have more than 4 of these positions, right? Because depending on how popular these stocks, people are like Nvidia. People are piling into the trend. All the models identify that Nvidia and Apple are the outperformers, but at some point it's going to roll over. So if you have more than 4 positions, it's very hard for you to manage them. So I propose 4 positions and the maximum loss of 2.5% per account value, right? How do you determine 2.5% account value? We do have tools. So if you're doing short-term trading, right, this model basically tells you, listen, if we drop below 406, 405, which is the 2-week lows, right? The 2-week lows is about 405, 406. If we drop below that level, then we have set the top, probably for the rest of the year. So then you probably want to be more aggressive on the downside, hedge your portfolio more aggressive. So that's your kind of a line in the sand for the next 10 days. And if we do reach 420, again, market is overbought. So at 406, maybe you want to buy if you're aggressive short-term trader because you think that level will hold. But if we reach, January, February high, you probably want to short because the market is overbought, right? So we tell you support and resistance. So if you're doing short-term trading, basically if you buy in spiders, let's say today at, what is spiders trading? 411, you have 1% risk, right? On the $10,000 portfolio. Okay, if you're doing short-term trading, you can invest $10,000, right? If you're doing day trading or aggressive trader, you take $10,000, your stop loss is 1%, right? So you're risking $100. Maybe you put $10,000 at 406, and 1% is $100, and then you put another $10,000 of S&P. Am I doing this calculation correctly? Right. Okay, 1%, right? If you're doing short-term aggressive trader, right, you're thinking about hours or days, maybe 1 week. So then your support is 406, right? And you invest $10,000 at a time. If you're not comfortable, because we can reach 406 by the end of today, right? I mean, something happens in the market, you have sharp pullback. So if you're not comfortable, below 406, if we do drop below 406, the next level would be 400, right? So we could be at 400, early next week once the earnings start, right? We are already retesting this key support at 410, right? We actually today low 410, right? So we're knocking on the door of 410 multiple times. If we break 410, we will be at 406 very quickly. So next week we could be at 406. So then means that you're thinking about more weeks, the next level is 400. So maybe instead of putting $10,000 into S&P, you put only 5,000, right? Because if you buy it at 410 and it drops at 400, that's 2%. 2% of 5,000 is $100, right? So the idea, if you average account is $10,000, you always look at these support and resistance levels, and you ask yourself, how much am I going to be down at these levels? And if the answer is $100, right, on $10,000 account, and you have a strong opinion that we have reached the bottom and market is heading higher, great, then that's the trade, right? That's the trade. If you invest $10,000 and then when we reach 406, you decide, well, I'm going to wait a little bit longer because, I believe that, Apple and Microsoft are going to hit a home run, and then they don't, and we reach 400 level, then all of a sudden, if you invested $10,000 and the market is down, more than 2.5%, then you're down more than $250, right? So the idea is to never be on the $10,000 account. This is a trader's market. I would encourage to take any position and split it in two. Never be down more than $100, right? You can be a bull, you can be a bear, you can think sideways or not have an opinion, but you look at these tools and you say, okay, if I'm thinking about days and weeks, at 405, I want to be down less than $100. If I'm thinking about, days. If I'm thinking about hours, probably 410 is your support, right? If I'm thinking about weeks or month, I would size it to 380, right? Because if we don't hold 400, well, we're going to be at 380 rather quickly, right? It could be a couple of weeks and we're at 380, right? Especially after the next 2 weeks, earnings are going to be done, and we're going to ask for what is the next catalyst to take the market higher. Well, we don't have China reopening, we don't have avoidance of energy crisis in Europe. I mean, there could be some other catalysts like end of Russia-Ukraine conflict, that's possible, or something else along those lines. But if not, and the earnings are weak and we're not hitting home runs, then people, and we're going to a summer, which usually not a good time of the year to hold long position, then we could rather quickly be at 380. So then the same process at 380, you do not want to be down more than $250. So if you buy an S&P at 380, 30, this is what, how much down? 10%, 8%, $30, 8%. So 8%, again, then how much can you do? You can't do 5,000, so maybe you do $2,000, right? You invest $2,000 in S&P out of 10,000. And if it's down 8%, okay, you're down $160, right? You're down, and then you can make a decision, will March and December low hold or will it not? Majority of you said that October low is there, then probably, you should be buyer at 380. So that is the most important skill to have, right? Is the risk management. And if you knew, you really don't have to be, all you need to practice. If I had to go back when I started trading, that is something I wish I learned, because my number one goal when I started trading is finding the next stocks like NVIDIA, right? That's all I care about. Like, how can I find another NVIDIA? And in bull market, maybe it makes sense, right? You buy an NVIDIA, you buy Tesla, and they keep going up to infinity. Who cares about risk management? But now we're in a different market, right? We're in a market where in the past 2 years, we didn't go anywhere. So it's not, finding NVIDIA is important. I don't want to underestimate this, or Tesla or Bitcoin, but risk management is a lot more important, right? So I would concentrate my mental energy on getting the mechanics of the trade, right? Not have more than 4 positions, not risk more than $100 per trade, and just do 50 trades, do 100 trades where you'd never lose more than $100. Once you do that, then you're going to be a much better trader. You're going to document all your trades. You're going to keep a journal, and you'll see how you perform. And then it's a business, right? You can set goals. You can set your weekly goals. You can set your quarterly goals, annual goals, and you can, based on how much money you manage, and you can, that would be the goal, right? If I make, 20, 30% a year on my portfolio, that is my goal, right? And every year, every quarter, I continue to increase that number. So that's the goal, right? How do we help you at Tradespoon? Again, I talked about Stock Forecast Toolbox, my favorite tool. I think it's really great for support, resistance, and trends if you use it properly. A lot of people open up a ticket, say, Vlad, you said on May 4th, we're going to be at 420, right? And May 4th, we are at 380. What happened? I'm going to say, well, Microsoft had a poor earnings, Tesla had a poor earnings, model did not know that, we had bad, whatever, and market sold off. So you can assume that on May 4th is going to be 420. What you can assume that at 406, and if you're a short-term aggressive trader, maybe it makes sense to buy. And if you're short-term aggressive trader at 420, maybe it makes sense to sell. And right now, neutral trend. Right, so kind of trading in a sideways between 406 and 420. That is a very important information, and this is very important data to be a successful trader, right? So we help you with Stock Forecast Toolbox. If you want to follow my trades, we do have Elite Circle, right? You can see all of my positions at any given time. If you want to see, Vlad, what do you trade right now? Okay, I just bought TLT, right? I think TLT is heading higher, right? So you can see all of my orders, you can see all of my positions, you can enter your phone number, you get an SMS message, and you can always see the recordings. Any questions? Trader, is there going, if there is a strong lower conviction, crash, then SA. Cash is greater than SH hedge or a balance. If you have a strong conviction that the market is going lower, I would say you should have 50% of your portfolio in cash. Another major crash of 2020. Kevin, thank you for your feedback. I don't think we're going to have, 1920, but no. All right, TJ. TJ, for now, the futures data, we're having issues with our quote provider. So we're trying to see if we can get that, but stay tuned. For now, we don't have the data for the futures. Thank you, TJ. For now, you can use SPY. You can use SPY. They're one-to-one correlated. So I would encourage you to use SPY instead of futures. Anyone else? Any other questions? All right, 10:25. This is all I covered for today. If you guys don't have any other questions, then short term, I would watch probably 406 level, right? If we drop below 406 level in the next week or 2 weeks, I would say that this top building process is probably over, right? And we're either going to trade sideways or continue to make new lows. So that's a very important level, 406. And then I would watch 400, right? If we do break below 400, we're quickly going lower. On the upside, I guess we could have a positive surprise and break through the February high. We're very close to that. So you can assume that, if we have a home run next week in terms of earnings, we will get to August high 430. I think the likelihood of that event is much smaller than us, than the market reaching 400 level. So if I have to pick 430, right, 20 points, this is how I always think. What do I think? Do I think market is going to be at 430, right, 20 points to the upside versus 20 points to the 390? I personally pick 390. If you pick 430, you're buyer, right? You should be buyer. If you say lower, then you should be a seller. But you don't have to make that decision right now. You can look at the data, right? So if we break below 406, maybe that's your signal to start shorting. If we break above year-to-date high, January high, 416, 417, okay, you can try to squeeze a couple more percentage to 430. Can you show some performance? Yeah, if you want to see performance of all the trades, you can just click here. So every trade gets recorded and you can click on performance, run. Kevin, with all the right, this is all of our models and all of our tools like Active Trader, Weekly Trader. This is all, thank you, Kevin. This is all based on AI tool, right? Machine learning. We have neural networks provided by Google, Microsoft. They have these frameworks, open source frameworks for neural networks. So we are using neural networks to identify stocks that are outperforming the market. So one thing we do well is identifying stocks that are performing. So whether it's Active Trader, Weekly Trader, or Monthly Trader, these are the stocks that should outperform their respective indexes. Thank you, Kevin. All right, any other questions, suggestions, feedback? All right, you guys been awesome, great. Thank you very much and have a great day. Thank you.